Berkshire is going to do what it thinks makes sense for shareholders. And we like investing in companies that think that way too. And not all companies obviously do.
Berkshire Hathaway's second quarter 2020 earnings update revealed to us that Warren Buffett has spent $5.1 billion on investing in a single company. And the amazing thing is, there really hasn't been that many people talking about it. You can find the stock that Berkshire is buying in the latest 10Q SEC filing. Just head down to the cash flow statement and in the investing activity section. Wait, who am I kidding? That's my job. So you just sit back and relax and all will be revealed in today's video. Firstly, I'm going to discuss Berkshire Hathaway's growing cash pile, as well as some of the recent investments they've made in 2020. And then I'm going to reveal their most recent investment and then what it means for Berkshire Hathaway shareholders, but also for really anyone who is investing in the markets. I put a ton of effort and research into making this video, so if you do enjoy it, I would very much appreciate it if you could take the time to go below this video and leave a like, and also leave a comment if you want, sharing your thoughts on what has happened to their recent investment, or if you have any questions, I'll be down there answering questions as this video goes live. Recently, a hot topic for long-term investors has been Warren Buffett and Berkshire Hathaway's growing cash pile. Warren Buffett is a long-term and value investor, which basically means that his cash pile will build up when there is a lack of good investment opportunities, businesses, stocks that can offer and generate a high return. And then that cash pile tends to go down sharply when there are many opportunities available, or even when there are just a few small opportunities available. And these kinds of opportunities typically come about when there is broad economic weakness. So in other words, a recession. But it also comes about when there is a problem or an issue happening with a specific business, or maybe with one specific industry, even while the rest of the economy is performing quite well. But as of recently, this cash pile for Berkshire Hathaway has just been going up, even after we saw a 38% drop in the US stock market earlier this year. From 2008 to this year, 2020, Berkshire's cash and cash equivalents on their balance sheet has grown from about $30 billion all the way up to $147 billion as of their latest quarterly filing. For those who don't know, cash and cash equivalents is a figure on the balance sheet which includes, you guessed it, cash, but also US Treasury bonds, because they are considered risk-free investments. And the practical reasoning for why Berkshire's cash pile has been going up is because Berkshire's businesses have been producing cash flow while they have made very few investments. A common interpretation of Warren Buffett's huge cash pile is that all stocks are overvalued and there are no available opportunities for him to invest and make a substantial return. But it's also important to consider Berkshire Hathaway's size as well as Warren Buffett's investment philosophy. Warren Buffett's investment philosophy is to find a small number of businesses that he deeply understands. So what that means for Berkshire is that as Berkshire gets bigger and has more cash flow that needs to be reinvested back into businesses, the businesses that Berkshire can invest into need to be bigger and have been needing to be bigger over time. Their most recent example of this is their investment in Apple. Berkshire currently holds over $90 billion worth of Apple stock. The position represents 4.6% ownership in the company, but over 40% of Berkshire's stock portfolio. But Apple isn't your average American company. In fact, it's the largest publicly traded company on the US markets. And 99% of companies just aren't big enough for Berkshire to invest and generate a significant enough return. With all that said, Buffett has made some significant moves in the stock market in 2020. In April, Warren Buffett and Berkshire Hathaway sold out completely of their stakes in the 4 major US airlines, those being American Airlines, Southwest Airlines, Delta, and United. He sold out of these airlines at a significant loss, which adds even more confusion to the conversation. So not only has he been very inactive in buying and investing in new companies, one of his most significant investments from the past couple of years even turned out to be a mistake. More recently, as of July this year, Buffett made a $10 billion investment. But instead of buying part of or an entire company, he invested $10 billion into natural gas assets such as pipelines from the company Dominion Energy in order to expand their existing energy business. But neither of these investments are what I am going to discuss today. This week, in the latest Berkshire Hathaway earnings update, we found out that Berkshire Hathaway have spent $5.1 billion of cash on a single stock. And that stock is Berkshire Hathaway stock. Now, some of you might be sitting there scratching your head and thinking, wait a second, how can Berkshire Hathaway invest $5.1 billion into their own stock? Well, what this is called is either a share repurchase or a stock buyback. I'm going to be using those two terms interchangeably. They mean the same thing. This is when a company uses cash to buy some of their own shares from the public. When this happens, the company's cash goes down as they are using it to buy stock, and the shares that they buy essentially get deleted out of existence, ultimately reducing the total number of shares that exist for the company. And when a company does this, it has two key effects that are important to understand as an investor, whether you're invested in Berkshire Hathaway or any other company, because let's face it, most companies are doing share repurchases these days. The first effect is, of course, that cash goes down in the bank account on the balance sheet for that business. And this is, of course, important because that cash that they use to repurchase stock can then, of course, not be used to make other investments, to invest in the assets of the business, or even to pay a dividend directly to the shareholders. The second effect is that the total number of shares that company is broken up into goes down. And as a result, percentage ownership for existing shareholders goes up. So let me go through a quick example so that this makes complete sense. Imagine there is a company with 4 shares and you own one of those shares, 25%. Now let's imagine that the company uses some of its cash to repurchase one share, and that one share gets deleted. Now you own 1 out of 3 shares, which ultimately means that your percentage ownership has increased from 25% to 33% of the whole company. And while an increase in your percentage ownership might sound fantastic, buying back shares or repurchasing shares is not always a smart thing to do. In fact, I think most of the time when a company is repurchasing stock, it is not a smart thing to do. It is only smart if the stock is being repurchased at a price below the value of that business.
Whether the company should buy it depends on a couple of things. One is they ought to retain the money they need for intelligent growth prospects. That's fine. Secondly, and this is a point that's never mentioned, they should be buying it back below what they think it's worth. Now, they'll make mistakes in that, but you make mistakes in a lot of business decisions, but that should be the guiding principle.
If the shares are repurchased at a price that is higher than what they are worth, then the shareholders would have been better off if the company just used that cash to pay a direct cash dividend to the shareholders instead of repurchasing stock. So here's a quick sort of easy example that might help you understand that. Think of it like you are buying shares personally. When you buy shares, your cash goes down initially, right? You outlay cash to buy that stock. And then you expect that stock, that business, will deliver to you more than you outlaid initially. And if there was a stock where you outlaid $1,000, you paid $1,000 to invest in a company, and it delivered to you, it returned to you only $600 over its remaining life, then you would have been better off if you had just kept that $1,000 in your bank account as cash. And the same thing applies for businesses that are repurchasing their own stock. So the bottom line here is that if Berkshire Hathaway is using a significant amount of their cash to repurchase their own stock, it indicates to us that Warren Buffett and Charlie Munger believe that Berkshire Hathaway stock at its current price is undervalued, that it can deliver to you substantially more than what you can pay for the stock today. So I hope you guys enjoyed this video and got some value out of it. If you have any thoughts on this or have any questions about investing in general, as always, you can head down to the comment section and leave me a comment down there. I'll be answering questions as this video goes live. And as I said at the start of the video, this took me a long time to put together. together. So I would very much appreciate it if you could leave a like on the video if you enjoyed it. And of course, hit subscribe if you want to see more content regularly and you want to be notified when new content is coming out. But other than that, I hope you guys have a great day, and I'll see you in the next video.